All right, everyone, let's get started. Today, we are going to do a deep dive into a concept that is, and I mean this, absolutely crucial for understanding how modern, idea-driven companies really work. We're talking about amortization. And I want you to get this straight from the beginning. This is not just some dusty old accounting rule. No, this is a powerful strategic tool that directly impacts how you, as a future manager or analyst, will figure out what a business is actually worth.
So let's just start with a quick thought experiment. I want you to picture some of the biggest companies out there today. You know, the Googles, the Pfizers, the Disneys. What is it that truly makes them so valuable? Is it their fancy office buildings? Is it their computer servers? Or is it something you can't even touch? Think about it. A patent for a drug that could save millions of lives. The source code for an app that changes how we live. The copyright on a character that's loved around the world. These things are called intangible assets, and for many companies, they are, by far, the most valuable things they own. So the real puzzle for us, as people who need to understand business, is this. How in the world do you take something as abstract as an idea and put it onto a formal document like a balance sheet? How do you put a price tag on innovation?
That's going to be our first big job today. We're going to build a bridge. On one side of the bridge, you've got the idea, the concept, the abstract stuff. And on the other side, you've got something very concrete and very real, a line item on a balance sheet. We're going to walk through the exact accounting framework that lets us translate the value of an idea into a number we can actually track, manage, and make decisions with.
Okay, let's make this real. Let's pretend we're on the management team of a software company. Let's call it Innovate Software. We just made a huge move. We spent $1 million to buy a patent. And all our research shows that this patent is going to be a moneymaker for us for the next 10 years. Now think about the accounting rules. For our first-year income statement, what do? If we just write off the entire $1 million cost as an expense right away, what happens? Well, we'd have this massive expense that would probably make it look like we lost a ton of money. So let me ask you, does that really show what happened? Does that one number, which makes us look like we had a terrible year, truly represent a smart investment in our future? Of course not, it's misleading. And that's the problem we need to fix.
And wouldn't you know it, there's a perfect solution. There's an accounting tool that was designed for this exact situation, to fix this exact mismatch. And that tool is amortization. This isn't just some made-up rule, it's based on the core logic of accounting, and it's what allows us to tell a much more honest story about our company's performance over time.
So here it is, the formal textbook definition. Looks pretty simple, right? The process of allocating the cost of intangible assets over their useful life. But in accounting, every single word matters. Each piece of this definition, allocating the cost, intangible assets, and useful life, is incredibly important. So that's what we're going to do now. We're going to take this sentence apart piece by piece, because if you don't understand the components, you'll never really get the whole concept.
Okay, first up, intangible assets. Just like the name says, these are assets you can't physically touch. In our Innovate Software example, the patent is the perfect intangible asset. Other classic examples you'll see all the time are things like copyrights that protect books or movies, trademarks that protect a brand's logo and identity, or even things like franchise agreements. When a company buys one of these, it goes on the balance sheet at whatever price they paid for it. And you know what? These assets are often the secret sauce, the very thing that gives a company its edge over the competition.
Next, we've got to figure out the useful life. For our software patent, we said it would be useful for 10 years. Now, this is so important, so I really want you to focus on this. This is an estimate. It's not a wild guess. It's a very educated judgment call that management has to make. They look at all sorts of things: how long the patent is legally protected, what's happening with technology in the industry, what competitors are doing, and what their own business plan is. The reason I'm stressing this is because figuring out the useful life is one of the biggest areas where management gets to make a judgment call. And as a future analyst, you always have to ask yourself if that estimate seems reasonable. And finally, we get to the action part, allocating the cost. This is the how-to of amortization. Instead of taking that huge $1 million hit in the first year, we're going to spread that cost out evenly over the patent's 10-year useful life. The most common way to do this is called the straight line method. It's super simple. You just take the cost and divide it by the useful life. So $1 million divided by 10 years, that's an annual amortization expense of $100,000. See what we did there? We completely changed the story our financial statements are telling. We went from a single, misleading number to a much smoother, more realistic picture of how the company is actually doing.
So why do we do all this? What's the big idea behind it? Well, it all boils down to one of the most important rules in all accounting, something we've talked about before, the matching principle. Remember that? The whole point is to record expenses in the same period as the revenues that those expenses helped create. Since our patent is helping us make money for 10 years, it only makes sense that we should match the cost of that patent against the revenues over that same 10-year period. It gives us a much clearer picture of how profitable the company really is from one year to the next.
Okay, one of the best ways to really get a handle on a new topic is to compare it to something you already know. And it just so happens that amortization has a very close cousin in the accounting world. And if you understand how they relate, this whole thing will just click into place. So I'll ask you all to think about this. When a company buys a delivery truck, or a factory, or a big piece of machinery, something physical you can actually kick, we do the exact same thing. We spread its cost out over its useful life. What do we call that process? The logic is exactly the same, but we use a different word. And that process, as I'm sure many of you remembered, is called depreciation. The difference is super simple, but it's a hard and fast rule. Amortization and depreciation are basically the same idea. You're just allocating the cost of a long-term asset. The only difference is what kind of asset you're talking about. We depreciate tangible assets, stuff with physical substance, and we amortize intangible assets, the patents and copyrights we've been talking about. Same idea, different words, and a different line on the financial statements. It's that simple.
All right, let's talk about a common mistake. This is something that trips students up all the time, so I want to make it crystal clear. Amortization is what we call a non-cash expense. What on earth does that mean? Well, think about our example. The actual $1 million in cash left our bank account back in year one when we bought the patent. That's when the cash was spent. The $100,000 amortization expense that we record in year 2 and year 3 and so on, no cash is leaving the building in those years. It's just an entry in our accounting books to match the original cash payment to the years it's helping us. This is so important when you get to cash flow analysis. On the statement of cash flows, you actually start with net income and then add back non-cash expenses like amortization. Forgetting that is a classic rookie mistake. So, we've covered the what and the how. But the most important question is always, so what, right? Why did we just spend all this time picking this concept apart? And the answer is simple. Because if you don't master amortization, you simply cannot make good business decisions in the modern world. It's not optional. Let's quickly follow the money, or the accounting entry, I should say. Let's see how amortization travels through the financial statements. First, on the income statement, that annual amortization expense shows up, usually as an operating expense. This lowers our operating income, which in turn lowers our income before taxes. And hey, lower taxable income means you pay less in taxes. That's a real cash savings we call a tax shield. Now at the same time, over on the balance sheet, we do something interesting. We don't just reduce the value of the patent directly. Instead, we add to a separate account called accumulated amortization. The final value you see on the balance sheet is the original cost of the patent minus this growing accumulated amortization account. So if you only take one thing away from our discussion today, let it be this. You absolutely have to understand amortization to have any real idea of a company's financial health. It's non-negotiable. When you're out there in the real world and your boss asks you to figure out if a company is a good investment or your bank asks you to analyze a loan applicant, you have to look deeper than just the net income number. A company that's all about ideas and innovation will have huge amortization expenses. And if you don't get that it's a non-cash charge from a past investment, you're going to get the story completely wrong. You'll completely misjudge how profitable they are and how much cash they're really generating. This stuff directly impacts stock prices, loan agreements, everything.
And I'll leave you with a final puzzle to chew on, something that will lead us right into our next topic. Think about two of the most powerful brands on the planet, Coca-Cola and Apple. You could easily argue that their brand name is the single most valuable thing they own. But if you go and pull up their balance sheets right now, you won't find a line item for brand that's being amortized. So my question to you is, why not? The answer gets into a really interesting distinction between intangible assets that you buy versus ones that you create yourself. It's a fascinating problem, and it's the perfect place for us to pick things up next time. Great work today.